Hello and welcome to this week's edition of Murphy's Market Minute with Elliot Omenson.
And Nathaniel Vossman.
You'll see Nathaniel walking back and forth. We're down a man. Aiden has decided to take the summer off, so our soundboard guy, our tech support, is missing in action.
Luckily, we only do the intro song at this point, so
not
a
a
whole lot on the soundboard.
Not a big loss. Not a big loss. So it's been a interesting and wild and crazy and fun and terrifying and stressful and everything else start to the year. But I really like what's happening because it just shows. I think there's some things that have happened here that, in my mind, kind of validate some of the actions and the steps that we took. And one of the things I like about having you on board is being younger. You have a very different outlook and a viewpoint, right? But you're also getting to kind of see the way in which we do things differently for people who are retired and living off of their money, and they're very different scenarios. Yeah. And so that's one of the things that I wanted to kind of talk about, because right now, since we took steps, a week ago? Is it 2 weeks ago? Okay.
Probably a week and a half at this point.
Yeah, I mean, we did our first round of rebalancing actually a month and a half ago or more. But then we really took steps when we called everybody about a week and a half ago. And so in the last week, so for the last 5 days, the S&P 500 is up 0.37%. For the last month, it's down negative 6.83. Year to date, it's down negative 10.1. All right. The Dow itself is getting hammered because United Health is down 22%, and United Health is the largest by weighted average component of the Dow, and the Dow today is down negative 1.27. For the last 5 days, it's down negative 1.08, and year to date, it's down negative 7.94, and that's not off of its high. That's off of where it started at the beginning of the year. It's down quite a bit more if you go off of its high. All right, but then the thing that matters most to a lot of us, because for most of our clients, we use money in the market as growth money. All right, we use money in annuities and life insurance as your safe money. All right, and so our money in the market is invested a little more aggressively than if you didn't have annuities in life, because it's the growth portion of your fund. And so it's pretty heavy tech. And the NASDAQ today is down negative 4. For the last 5 days, it's down negative 0.88. And year to date, it's down negative 15.87. And again, that's not off of its high. That's off of where it started at the beginning of the year. And it peaked somewhere in mid-February. All these indexes peaked somewhere around mid-February. So there's a lot of information out there that I feel like is given in a vacuum, right? And one of those is this idea that if you had an investment over the last decade or 20 years or whatever it is, and you missed the 10 highest days, then your investment is cut in half, all right? And so that if you just went off that one piece of information, you would want to stay in the market no matter what it did. And there was a beautiful day, was it April...
I think it was last Wednesday.
Yeah, last Wednesday, April 9th, okay, where the market spiked. What was it, 7 to 10%, depending on the index?
I think S&P ended up just below 10, if I'm not mistaken.
Yeah, okay. And now it's come down since then, all right? It dropped sharply the next couple of days. It climbed back up to maybe halfway to where it was, or a little over, like half of what it had lost in the days after, and now it's down to about half of that gain. All right. And so if you were just to take that one piece of information where by missing the 10 biggest days, right, you've cut your portfolio in half, you would just want to write it all out. But there's another really interesting exercise, and we have all the data, and I'll try and find it so Nathaniel can send it out. And what they do is they take from 1980 to 2010. And they assume you start with a $1 million investment, and you just get the returns and losses. So there's 4 major risks that face somebody in retirement. The first 3 are sequence risks: sequence of equity rate of return, sequence of bond yield, sequence of inflation. And then the 4th risk is the kicker that kind of magnifies the previous 3, and it's longevity. All right. And so one of the things I harp on all the time is that in 1952, when the modern portfolio theory got created, the average person was going to live, the average male would live 12.6 years in retirement. And today it's closer to 26 years in retirement. Well, that's 26 years for inflation to erode your spending power. That's 26 years for you to accumulate increasingly expensive medical expenses. All right. And so in this exercise, they take $1 million invested in 1980, and they just assume it gets whatever the sequence of equity rate of return is for the S&P 500 every year. So in some years it gains, in some years it loses. By 2010, that $1 million will have grown to 11.4 million. Now, if you reverse it and you were to flip it on end and start in 2010 and work your way backwards, so instead of getting 1980 first, you got 2010 first. Instead of getting 1981 second, you get 2009 second. You work your way back. You want to take a stab in the dark as to how much money you end up with?
It wouldn't be very much. I know that because
oddly enough, it's the exact same number.
And it's starting with
$1 million.
Starting with $1 million.
It literally doesn't matter.
Wow.
You end up with the exact same amount of money. It's 11.44 30 years later. It literally doesn't matter. Now, what's weird is those 30 years are kind of cherry picked, because if I go to like 28 or I go to 25, the numbers are different. It just so happens that 30-year time span, it comes out to the exact same end result. Now, here's where it gets interesting, though. That's before you retire, when you're in the accumulation phase and your money's just invested. What?
I said fair, yeah.
Yeah. Now, let's assume you've retired. You have $1 million in 1980, and now you're living off of it.
Then it changes.
Wildly. Okay, so from 1980 to 2010, starting at a 5% withdrawal and increasing for a cost of inflation, cost of living adjustment, you're down by 2010 to $500,000. Your portfolio worked exactly as it's supposed to. But if you reverse it and you go from 1980 to 2010, you're broken less than like 12 years. It's completely wiped out. In fact, you're negative like $400,000. And to be honest, I think it's actually 6 years is all it takes. All right. And so this highlights why I believe the current methodology of the 4% rule, and there's people much, much smarter than me, an economist by the name of Wade Powell, and we could probably provide his summary of his study as well. In 2012, he re-examined the 4% rule, and he found that it has a 57% failure rate. And yet this is what every financial firm builds a retirement plan off of, is the 4% rule and the 60-40 bond equity portfolio split. And so I just feel like if you're facing a methodology with a 57% failure rate, I wouldn't want 57% out of every 100 of my clients, which would actually be 57 clients, to run out of money before they retire. That just seems like an absolutely insane thing to be okay and comfortable with. And so we do something that most people will all tell you not to. And that's what we did a week and a half ago. We sold out positions just depending on who you are, your risk tolerance levels, your income needs, what phase of retirement you're in, what the purpose of the money is for. All these kind of things were taken into consideration. And then we moved somewhere between, for most people, actually, I think for like half the clients, we moved nothing, maybe less than half. Then the next largest portion, we moved 25%. Few people, we moved 50%. And even fewer people, we moved 100% over into cash. Now, we initially thought about doing bonds. We maybe go into a bond fund, but right about the same time, the bond market started getting annihilated as well. So there was no point from moving to equities to bonds if everything's going down. So we moved to a safe haven, cash, temporarily. And now we're just watching and waiting to determine how long this is all going to persist and continue. And there's some things in the news that I feel like could go either way. So the jobs report came out, blew out economists' expectations. Inflation, core inflation, is down even further. And there was another one. Oh, retail sales were fantastic. Now, the problem with all three of those reports is all three were taken off data before the tariff war started. Okay, so we have yet to see how the tariffs are going to impact these three things. But what those three things show you, regardless of the tariffs, is the state of the economy, right? And so I also love how during Trump's first term, when the markets were going up, the media's narrative was that all Trump cares about is the stock market. The stock market's not indicative of the economy, which is totally true. But today, with the market going down, Trump's crashing the economy. Well, wait a minute. I thought the market wasn't the economy. So why is the market not the economy when the market's going up, but all of a sudden the market is the economy when the market's going down? It's bullshit. It's a narrative. It's designed to stroke fear and uncertainty and doubt and make you think something politically when it's just not true. So in addition to that, we also have, and it's been brewing for a while, and that's the war between Trump and Powell, the head of the Fed. And Trump is pushing. So what Trump's doing with tariffs is not in a silo. It's not on an island. What he's doing, he's trying to do things across the board, from streamlining the federal government, getting rid of waste, fraud, and abuse, increasing revenue to the federal government through tariffs, lowering interest rates, lowering taxes, right? So while tariffs might increase costs to foreign imported goods, a decrease in tariffs and a lowering of the interest rate would offset that on American-made goods to a certain extent. Do you agree with any of this?
Yeah, I think it's exactly this plan. Like spur some growth with the lower interest rates. That's going to grow, domestically here, and then the tariffs. No tariffs on the American-made products. So that's designed to boost the American manufacturing, and then he wants to lower the taxes. Again, more growth, and then just getting some of that revenue through tariffs. And it's like, we don't mind, increasing the price there, because that's kind of the whole point, is to bring that manufacturing here. And then, with lower taxes, I don't know if it's ever going to happen, but, Trump is pushing for the no federal income tax on people making $150,000 or less.
Yep.
But that would effectively cancel out the tariff, especially when you factor in the fact that we'll say broadly there's a 10 to 20% tariff. We'll say 20%. But if people are, saving 20% on taxes a year, and they're not even buying exclusively foreign-made products.
No, exactly.
It kind of cancels itself out.
But not only would it cancel itself out, it would actually go to benefit the consuming class in America, which is the poorest of America. They account for 60% of all consumption. So if you eliminated taxes on those people and they could start to choose to buy American-made goods, I think it could be a big win.
Yeah, because with eliminating those taxes, you're effectively not really changing, or maybe even still boosting buying power.
Exactly.
So the growth is still going to be there.
Yep.
And boosting domestic manufacturing, boosting small business growth, all the above.
Yeah.
So it's kind of the idea.
Yeah, and so Trump loves his nicknames. I think they're pretty effective. And his nickname for Powell is Too Late Pal. Now, I do want to point something out, right? We have this tendency in our country for some reason to assign almost like a godlike status to people who we've determined to be, quote, experts in their field. And Powell is, obviously, he was appointed by Trump. He was renewed or re-upped, whatever you want to call it, by Joe Biden. All right. Now, Trump has soured on him. And it's funny to me that people have a problem with this. All right. So Trump is the leader of America. He's the executive power of America. It's his overarching plan that was voted for to be implemented. Now, when you're a leader, so I always go back to this analogy in the military. When I was running a team, I have numerous advisors. I have my medics. They're going to talk about what type of threat assessment there is that they're prepared to deal with, whether it's small arms fire, whether it's, a particular type of IED. Then you have, we even had a 96 Charlie, I think it was, a freaking meteorologist, I'm probably getting the MOS, the military occupational specialty signifier, wrong on the 96 Charlie, but I think it's 96 Charlie, and they were meteorologists. They're going to give you a weather report. You got your intel guys giving you SIGACs, like what significant actions have been taking place in the area. You got your route clearance and your EOD, and they're reporting to you, right? None of them are in charge. They don't get to run the country. They don't get to run the op. Their job is to provide information and do what the hell I tell them to do, right? If I let the medics run the op, what would we do? We would never go do the op because their number one priority is making sure everybody lives. It's not to accomplish a mission, right? If there's a bad weather report and the helicopter pilots don't want to fly because it's bad weather, well, then the op doesn't get done. No, your job's not to determine whether or not the weather can let you fly. My job's to determine that. Your job is to provide to me your risk assessment of it. And I might overrule you for factors you're not aware of and you don't comprehend because you're not me and you don't know everything that is trying to be accomplished, the time constraints we're under, the rarity of the opportunity to affect a mission. So Trump's doing exactly what he's supposed to do, which is run shit. And that includes the Fed. And I was at one of the most landmark speeches ever given. It was Governor Waller at the time, the chairman of the Fed. And I was in Jackson Hole for the Rocky Mountain Economic Summit in 2020, where he delivered a speech. Bloomberg was there. They broadcast it, where he talked about the soft landing. Now, what none of you know, if you weren't there, because none of this was actually broadcast or filmed, but everybody from Governor Waller to Paul Ryan, the former Speaker of the House, because he spoke, the chief economist for Wells Fargo, and I can never remember his name, super cool dude though, Paul McCauley, former head of PIMCO and current adjunct professor of economics at Georgetown University. Every single one of them stood up there and talked about how they have never, not one time, been right. Before Governor Waller delivered the speech, him and every other one of them talked about their track record of failing to get it right in every single other circumstance. And I remember at the time thinking, well, how do you stand up here and talk about being wrong every single time and then act like somehow you're going to get it right this time? Now, miracle of miracles, they really did. They achieved a soft landing, right, coming out of COVID. Something I don't know how many people really expected them to be able to pull off, but they did pull it off. So kudos to them, but that's one time out of 7 separate times over decades that they mentioned. And so to sit there and have Powell state that he wants to wait to see how something turns out, because that's what he stated. He had a speech yesterday, and he said he's not going to take action because he's waiting to see how the tariff thing plays out. There is nothing wrong with Trump saying that is absolutely the wrong move. Powell clearly is not aware of everything that's trying to be done and how it's all going to work together. And for Trump to say, no, you need to do this now to make it easier for him to affect the other things is perfectly correct. That is the absolute right move for a leader who has all the information and has the whole picture. And so, like, I love that Trump is making fun of this guy publicly, calling him too late pal, and putting pressure on him. That's his job as a leader, is to get the Fed to come into alignment with his overall plan. That's my opinion.
Yeah, I think most people are expecting a rate cut or multiple rate cuts at some point in 2025. And I think Trump's point is, like, why not just do it now? Why not just start now?
Do it now. Do it now so that all these things can actually mesh together and produce a positive environment for America. So anyways, ran over on that. But I just want to wrap this up with, going back to what we did. We raised that cash, and what we're waiting for is we're waiting to have, just like Powell, all right, but different, right? We don't have the ability to affect something, right? We're not Powell. We don't have the ability to lower interest rates to help with the overall thing. So what we have to do in this particular case is hold this cash position until some of this stuff, the dust settles. At which point, hopefully, and we don't have to be perfect with it, right? But when we move back in, that cash going in to those equity positions hopefully at a lower point than what we pulled out at, will give us a lot of margin, a lot of room for growth, and will really help with the long-term benefits of this portfolio. We successfully accomplished this in 2020. We went out in February, I think the second or third week of February, and we didn't go back in until after Memorial Day. And it was incredible, the benefits that we were able to affect in portfolios due to this. So the question is, can we do it twice? We'll see. So anyways, quick and dirty, Murphy's Market Minute. This is Elliot.
Nathaniel.
Signing off. Take care, everybody.